And I'm pleased to present these 2013 audited financial statements for your consideration. Management has asked that I give you a brief overview of the package. So if you turn into page 1, and it's called the index. So there's 28 pages and 29 if you include the title page. So after this one, we only have 27 more to go. Fortunately, I'll just be going over a few of them. But the index lists all of them. And notice at the bottom there, you'll see a separate set of audited statements for the trust funds that are under the county's umbrella. So if you go to the next page in, with the little number 2 in the bottom right-hand corner, it's got independent auditor's report on the top. And cutting through all the words, it is a clean audit report again this year, and in our opinion, we think the statements present fairly the position of the county. You'll notice the date, June 27th, 2014. Last year's statements, the 2012s, were August the 13th, 2013, and 2011s were November 9th, 2012. So we moved it up 3 months last year and another 2 months this year. So congrats to Mr. Ford and crew for pushing this audit reporting date up to a more current time period. If you turn one more page into page 3, it's entitled Management's Responsibility for Financial Reporting. The audit report, that last page, is our job. The financial statements are management's, although we do assist with their preparation. This report explains that, and it's signed by Keith Robichaud, the county manager, and John Ford, the county's treasurer and CFO. If you'll flip to page 5, it's entitled Your Consolidated Statement of Operations. Income statement to us old-timers. You'll notice it's got 3 columns. 2013 is your budget numbers. 2013 is your actual compared to the 2012 actuals. And my comments will be mostly geared towards the actuals, which is what we audit. At the top part is your revenue. You'll notice total revenue under 2013 is about $166 million rounded, compared to 161 under 2012. It's up about $5 million, or about 3%. The increase is mainly in the taxation line, $69 million versus $67.6 last year, an increase of about $1.7 million, or about 2.5%.
Just an interjection, we're on page 5 of our report.
Page 5
correct?
in the bottom right corner.
Thank you, just want to make sure we're all together here.
The other increases in the provincial grants, $50 million versus $48.6. It's up about $1.7 million, and that's mostly infrastructure grants. It is referred to Note 11 and Note 12 for federal and provincial grants. I'm not going to go on at it, but it's page 18 in your notes if you wanted to. But the increase in the provincial grants is mostly in infrastructure. And that's also why the budget's so different, is because we don't budget for infrastructure grants. They're not a certainty when we apply for them. The other increase is other income, which is on page 19, reference to note 13. Once again, you can turn to it if you like, but $9.9 million versus $8.9 last year, an increase of about $1 million. Most of that is an increase in the dividend you received from Norfolk Power, Inc. In 2012, that dividend was $1.4 million. In 2013, that dividend was $2.7 million, so an increase of about $1.3 million. So those 3-line increases explain the increases in your revenue for the most part. Expenses, they're $158.6 million, up about $2.1 million from 2012, about a 1.3% increase. There's swings in each line, but some of the main ones, your protection services down about $1 million. Your policing costs went down in 2013 compared to 12. Transportation services are up about $1.5 million, and that's the tough winter we had this past year, and I expect some trickle in 2014 on that. Social and family services and social housing. Social and family services went up about $1.6 million, and social housing went down about 2.4, for a net decrease of about $800,000. Your program and the related funding does swing sometimes, and this is one of those years. It's basically a flow-through. If you're down there, you'd be down in your revenue up above. So all in all, if you take your increase in revenue less your increase in expenses, you have a $7.7 million consolidated annual surplus this year compared to $4.7 million last year, an increase of about $3 million. So a good year for the county. I wanted to point out that before we start passing out some refund checks, that annual surplus includes depreciation and amortization of our existing capital assets and excludes purchases of new capital assets to replace the fully depreciated ones. So I wouldn't mind you turning to the next page. That helps us see that a little bit better. So at the top of page 6, that surplus number, annual surplus, has been carried forward, $7.7 million. You can see the amortization number of 19.8, which is added back there, and a bracket around the acquisition of tangible capital assets of about $27 million. The difference being a net bracket of about 7. So, and that excludes any long-term debt repayments, which have also declined about $2 million since 2011. So after it's all said and done, we've spent our annual surplus by covering some of our ongoing capital expenses and reducing our long-term debt levels. So good job in the short term on that. If you can go to page 4, going backwards. It's entitled the Consolidated Statement of Financial Position, or some of us refer to as our balance sheet. At the bottom, the accumulated surplus number of $492 million is what we just went through on the last page. And you'll also see our tangible capital assets number was $491 million under 2012. It's $498 under 2013, and that's an increase of about $7 million. Remember from page 6, we depreciated 20 and we added 27 for a net increase of $7 million. The assets at the top, they exclude your tangible capital assets. We refer to them as financial assets. You'll notice that they're $97.9 million versus $86.4 million under 2012, an increase of about $12 million. If you add up the first 2 lines of cash and investments, they total about $39 million, $25 million if you add the same 2 numbers in 12. So there's an increase in cash and investments of about $14 million. Taxes receivable, you'll notice, is $10.9 million. It was $12.4 million in 2012. So it's decreased about $1 million, and that's down once again from 2011 where they were 13. So the decline in taxes receivable is good. Accounts receivable is all the other stuff. $15.2 million under 13 and $16.4 million under 12. So a decrease of about $1 million for some grants and HSTs that were larger than usual outstanding in the previous year. In terms of liabilities, your payables, $15.5 million at the end of 12. $20.5 million at the end of 13, so an increase of $5 million. Nothing extraordinary there. It's just the timing of when your bills are paid, which might be one of the reasons why your cash is a little higher at the end of this year than it was last year. Deferred revenue, $14.8 million under 12 and $18.3 million under 13, an increase of about $3.5 million, and that's mostly an increase in the gas tax revenue that you received during the year that you haven't spent yet, and that'll get put into revenue when we eventually spend it on those authorized projects. Long-term liabilities is your outstanding debt, $43.8 million at the end of 13 versus $41.6 million. So you issued about $6 million of new debt and paid off about $4 million of your existing debt for a net increase of about $2 million. So all in all, the county's historical balance sheet's in still good shape. The other page I do want to go over, my last one, would be on the accumulated surplus, note 10. So go to page 18. I've often heard that surplus in the not-for-profit world is a dirty word, and I disagree. I encourage it, and I just think we need to educate our consumers and taxpayers as to what it all means. A healthy accumulated surplus number is a good thing. This page breaks down the counties a little bit. You'll see our total accumulated surplus at the end of 2013 is $492 million. If you look at what that's comprised of, at the top is our biggest, is our net investment in tangible capital assets, or our infrastructure. $453,679,000 at the end of 13, an increase of about $11 million over 12. That also represents about 92% of our accumulated surplus. The next biggest number is our investment in Norfolk Power of about $32 million, about the same as last year, but that also represents about 7% of our accumulated surplus. So those two numbers combined, about $486 million, comprises the largest part of our accumulated surplus. The investment in Norfolk Power, based on the sale, will take a nice increase next year, probably of about $34 million. If you do the simple math, it sounds like we're getting about 66 net after debt. We have $32 million as our asset, so the increase will be reflected in this page sometime in 14, once that's all said and done. But if you take 492 as the largest part comprising our 486 of our accumulated surplus, the rest is just our reserves. And if you add all those up, there's about $6 million left in our net reserves for the future. The bottom line is that our accumulated surplus was less than 492. If our accumulated surplus line was less than 492 to support the same level of infrastructure, our debt would have to go up. That's the only way to balance it off. So good job in terms of accumulating that surplus, and don't be ashamed to keep it going. If you want to go back to page 4, as I said, the county's historical cost balance sheet is still in good shape, so congratulations on that, and good luck with the rest of 2014, because it sure seems like it's busy out there right now. Any questions of me in the statement?
Thank you very much. I'm sure there'll be questions. We'll start with Councilor Black, please.
Yes, thank you very much. Thanks, Jeff. Sounds like it's good news all the way around. I know the taxpayers never look at it that way, but from the statements, I think the statements are looking pretty good. I just wanted to understand the surplus a little bit more. Compared to the old method and the new method, what would generally have happened to that surplus under the old method? And it seems, maybe I'm going to show my ignorance here, but it seems that this, that the annual surplus is being used to pay down accumulated depreciation. Is that what it's doing?
No.
No?
That's just how we record the expenditure on what we used to expense all at once. When you used to go out and fix a road, build a bridge, or whatever we did with it, the total of that expenditure was reflected on that page 5 statement as an expenditure in the year. When the new rules come into play, we say, park that road on page 4 if it costs you $5 million, and amortize that over the life expectancy of that road, which is 40 or 50 years. So it takes a piece of that new road and allocates it to the year that we're using it up in.
Okay.
What you used to see in the old rules was more on page 6. That depreciation number of $19.8 million wasn't there. It wasn't in the expense numbers on the previous page.
So
all we showed was the $27 million as an expense on capital assets in the year that was spent.
So would
So
that,
your old method is more likely to show a $738,000 surplus.
so the old method would be a false presentation of the numbers.
The old method? Well, what it didn't do was reflect, I think, it's complicated your statement somewhat, but at least it tells us as the taxpayer what types of things we have under our control. And our capital assets, if you look at them on page 16 in the notes, it was more of a cash basis of accounting, I think, Pete, in the older days. This is more like the real world does their accounting.
Yeah, like how business does it.
Yeah. And some people don't care about amortization and all those things, but page 16 on note 9 on your tangible capital assets, that information wasn't on your old statements. We didn't know what the total was, and now you have an audited asset base. It doesn't reflect what the replacement costs are going to be, which I think is what you should be doing with your reserves and capital expenses over the next 10 years or so. But at least this tells us that we got $766 million of assets under our care, and about $267 million of it has been written off through depreciation, so we got about $500 million left. Does that mean anything to lay people? Not unless we explain it to them.
Yeah.
And that's
Okay.
what we should be doing, is explaining to the taxpayers why we need the money we're charging them and what's in it for us down the road.
Okay, thank you for that. Just one last question on the surplus. If we turn to page 5, under budget,